With the recent carnage that's been developing in the oil markets recently, with the pricing under pressure, and we're talking here specifically about a futures contract in West Texas Intermediate, but it has had a lot of downward pressure on spot prices for the price of crude oil. And we're talking now to John Mayer from SP Angel, and this in specific regard, I know, John, to the Asian markets. And in just a minute, I want to talk as well about the coronavirus and the mining companies and the outlook there. But let's focus on oil first of all and discuss. There's the first stage of the interview about why this has happened and the technicals around the effects of this pricing issue.
Well, there have been huge inflows into Asian oil-based ETFs, and these oil ETFs are based on the West Texan Crude Index or price, and those huge inflows of course, this massive buildup of ETFs based on the May futures price, and the problem is they base those ETFs on buying the May futures on the West Texas exchange, but they've got no ability. These are effectively passive funds. They don't have any ability to actually deliver the material into the physical market. And short-term futures are normally used for physical markets. And what's happened is the price has cratered, and there's no you aren't able to book any more delivery slots. And the cost of what the real problem here is the cost of rolling over those futures contracts is such that it will wipe out the ETF investors entirely. So this is a major problem, and the number we've seen is that there is $1.2 trillion worth of ETF contracts based on the West Texas futures price, and that means it's going to be a big problem. Particularly, these instruments are particularly sold in South Korea and around Asia, but mainly South Korea. And there was another 2.4 billion of inflows since January. So we're talking very large numbers here.
Indeed, your research out today suggests that Asia will be adversely affected. You just illustrated a couple of points there, which could give us some reason for that. But more broadly speaking, is Asia more on the brink, if you like, compared to the West in terms of the general market moves at the moment, not just necessarily around oil, but do you see Asia as being a more risky place to be?
Well, yes, certainly. I mean, if you think back to the Asian crisis, okay, that was some 20 years ago, that uncovered an awful lot of graft and corruption. There were vulnerable companies that got caught up into it. It was sparked off by effectively not currency manipulation, but the Thai baht currency peg against the US dollar, and effectively Thailand was bust. So that created the Asian crisis. But there's always a spark to light the fire, and we saw a significant Singaporean oil trader go into administration just a couple of days ago with $800 million worth of losses. We already expected off the back of that a number of other Asian oil traders to go bust. This further exacerbates the crisis as far as we can see, and so it is likely that there will be further contagion from this. We already know that risk officers around the world are telling their metals traders and commodity traders in general to pull back on their risk, and this is pulling money and liquidity out of metals markets and other commodity markets as we speak. And so all these actions come together and create further market problems.
But markets they're very good at pricing in some of what could happen in the future. But we've spoken before about the importance of China in being the economic motor of the world in some regard. Surely China, being centrally placed in Asia and obviously using a lot of other Asian economies for various parts of what it needs in terms of building this nation that China wants to continue with, this Belt and Road that we've been hearing about. Surely China remains the main economic engine of the world, and is that not going to help Asia?
Well, on the positive side, China is getting back to work. Already the factories are back at work, and the car dealerships are open and stuff like that. And if we look at Rio Tinto and BHP's quarterly results just out this week, they show that in fact iron ore shipments into China from Rio Tinto were 16% down in the first quarter, which wasn't a bad performance given what's going on. BHP was actually better. With the production was 1% down on the previous quarter, so good performance there. Some of that driven by problems in Brazil, but the problem is there's a problem coming at us in that the United States, which is the world's major consumer, and it takes a lot to stop Americans from not consuming things. They're going into their own they're already in their own coronavirus lockdown. Consumption is certainly slowing. They're heading for recession, as is Western Europe as well. And it's worse than that. Credit companies are now reducing people's credit ratings around the US. And so we're expecting the level of consumption from your average US consumer to fall. So if you think that China produces a lot of export product that goes to the States, where are they going to sell it? So the Chinese authorities, who normally like to spend money on infrastructure to dig their way out of any slowdown, are going to have to either increase domestic Chinese consumption, which they never really like to do. They don't like the idea of helicopter money, or they're going to have to do something else that's more dramatic, because just infrastructure spending isn't going to keep all these manufacturers busy in China and isn't going to help them get back to their 6% growth rate.
And of course, you add the problems, as you say, with the oil markets into that, and of course, it provides a very dangerous cocktail. I want to move on, though, John, if I can, and take a look at something which struck me from a paper that was issued by SP Angel a couple of days ago, talking about the longer-term impact, the positives coming out of coronavirus on the mining sector. Give us some more detail about what you're seeing in terms of some of the things that could change positively out of this crisis that we're going through at the moment.
Well, we've been talking to a number of mining companies, and in fact, this isn't an especially new idea, but the coronavirus situation is going to accelerate the introduction of a lot of new automated technology. So mines now have very good reason to keep people socially distanced. That means slightly fewer people working in these mines. There's an opportunity to pull out some of the excessive workforces that often mines get landed with in remote locations. So more automated machinery, better use of energy, probably fewer but longer shifts. So you're going from 3-shift working to 2-shift working with no overlap at the end of each shift, which is important from a social distancing perspective. And actually, certainly with open cast mines and processing plants, you have an environment where people can work in safe and socially distanced conditions. But there's a lot of new automation to come in. Rio Tinto and BHP already have driverless trucks, driverless trains, and pretty much totally automated iron ore mines in Western Australia, where it's very expensive to employ people because it's so damn hot and because it's so remote. So employing even a truck driver in Western Australia costs $200,000 a year, and that's just his salary before you add on all the other costs. And he likes to have a couple of weeks, 2 weeks off every 2 weeks, that sort of thing. So these guys get very expensive, but now other mines can follow on and use the technology. There's a company around the corner from where I live in Oxfordshire. If you go into their office, you can see the tyre pressures and tyre sensors on trucks running around coal mines in Queensland and Australia. So there's a lot of this sort of technology that is already coming in, and we can see companies allocating more capital to this going forwards.
Okay. All right. Some good potentially to come out of, as I said, this crisis that we're all going through at the moment. John, thanks indeed for joining us for our regular update from SP Angel. John Mayer, mining analyst and founder at the broker based in central London.